we, as the Operation Hope and in connection with the Chicago City Treasurer's Office, we encourage the 700 credit score community, and we're really here to serve you by providing classes like we do today that teach you the essentials of basic knowledge that you need to know. And we break it down in such a way that it's easy to understand. And our one-on-one sessions with coaches, either credit-wise or for home ownership, we get you on the path to success by breaking down those difficult or complicated things, so it makes it easier to tackle or makes it easier to take on. So today we have a very, very special guest who I'm so happy to present to you. His name is Bernard Whitsitt, and he's one of the best coaches on my team regarding home ownership. He has many years of expertise and knowledge in the business, and he's here to share with us just a tidbit of what he knows and present to you how the home ownership program works. So without further ado, I am going to turn it over to Mr. Bernard Whitsitt, and he's going to talk to us about home ownership.
Okay, so my name, as Natalie stated, is Bernard Whitsitt. And I'm a financial well-being coach, HUD certified first-time home buyer coach as well. And as a HUD certified home buyer coach, I provide workshops that may provide access to funds or grants provided by HUD. So I do a 8-hour workshop in which it is a certification for first-time home buyers. And that certification gives you a certificate, which is good for 1 year, and it allows you to provide it to various banks in the area that provide grant and funding for down payment assistance or closing cost assistance. So that's something that you may want to consider depending on what you think about the presentation. So let's just go forward. So let's really talk initially about home ownership advantages and disadvantages, because I'm a believer that owning a home is not for everyone. Okay. And in fact, depending on the type of home you own, that's not for everyone. So oftentimes, the commercials, the advertisements will try to tell you what you need, subliminal advertising. And they want to push into your brain that you need to live in a suburb with a white picket fence and a 2-car garage and a puppy and a single family home. I don't think that's necessarily the case for many people. And I think the first thing we need to consider are, what are your options? So you can have home ownership with condominiums, own a condo. You can have home ownership with townhomes, as well as duplexes, as well as single family dwellings. So get an idea of what you think you want to own. Oftentimes I've run into people who say that, I want to buy a house only one time. Well, that's probably not realistic. Most people in their life typically buy 3 to 5 homes because they buy a starter home. And then after they have been in that house for a while, they tend to outgrow it and they can develop equity in the house. And then they'll sell that house and move into a medium-sized or larger home. So looking at the advantages of home ownership, whether you own a condominium, a townhome, or a single-family dwelling, typically it's a tax write-off. So you can write off the interest expense of your mortgage, as well as your property tax expense against your annual income. I also alluded to it being an investment. That people may start with a starter home and then move from a starter home to a mid-size home, and then from a mid-size home to a larger home. They're able to do that because historically homes have been a good long-term investment. So you develop equity as you're paying down the mortgage, you're reducing the principal owed on the property. But additionally, property values tend to increase over time. So that's another nice advantage of home ownership. A third issue is stable housing costs. And I would qualify that by saying it's stable housing costs relative to rental costs. Because when you lock in a 30-year fixed rate mortgage, you know how much your payment's going to be for 360 months. Okay, for 30 years. That is going to be your principal and interest payment for a fixed rate mortgage. What will change, of course, are property taxes. Property taxes can go up, right? The other variable that may change is the actual homeowner insurance cost. So as you move from a smaller home to a larger home, it will tend to cost more to insure it. And as a result, that number will go up. But a big advantage is it's one of the most popular ways for Americans to create wealth is through home ownership. Another nice advantage of home ownership is the legacy of it all. You can own a home, or maybe your grandmother has owned a home, and your grandmother left the home to you or to the family members. That's passing down a legacy. So you'll have the opportunity to pass down that legacy of owning a home, possibly passing it down to your children or your offsprings. And the other thing is, it tends that the value of homes, as well as the equity, because value goes up typically. But when the value goes up, the equity value goes up as well. So those are really the advantages of home ownership. Let's take a brief look at the disadvantage. If you're in the military and you know that you're moving every 18 months to a new tour of duty, well, it doesn't make sense for you to own a home, because you're going to have to turn around as soon as you buy it, as soon as you pay closing costs, as soon as you get comfortable, you got to move to another tour. So home ownership is generally not a good thing for people who are highly mobile. The other thing is personal choice. Some people like to repair things. Some people like to pay to get things repaired. Some people like to do maintenance. Don't like to do any maintenance at all. So you have to determine where you are on that spectrum as to whether or not you would want to own a home. When you own a home, you're going to have maintenance and repair costs. So keep that in mind. So you're going to have to either hire someone to do it, or you're going to have to do it yourself, or you're going to have to learn how to do it. And the wonderful thing about technology is that you can learn a lot of this stuff on YouTube. And due to COVID, prior to COVID coming, I know people used to go to various Home Depots and Lowe's on Saturdays and take various classes of how to put up a wall, or how to put down flooring, things of that nature. So there are avenues for individuals to learn how to do maintenance and repair. And not only maintenance and repairs, but renovations and upgrades. Another disadvantage, of course, are property taxes. Property taxes don't always go down, and they don't always stay the same. 9 times out of 10, your property taxes tend to go up. And I think we're currently in an environment where we will see property taxes go up across the nation due to COVID. As a result of COVID, a lot of the state treasurers, a lot of the city treasurers, the tills are low. And they're low because restaurant receipts are low. And they're low because the number of people who have been working and paying payroll tax has been reduced dramatically. So we know that the impact of an economic cycle is going to have some type of impact on your property. So you can expect property taxes to go up in the current environment that we are in. Another issue is, of course, additional cost. When you live in a rental property, there's certain things you don't have to worry about. You don't need to worry about the roof. You don't need to worry about the boiler, the hot water heater. You don't need to worry about the HVAC system. Those are all major components in home. Once you own the home, it's on you to take care of costs of repair and maintenance of all those various essential things, essential components of a home. People don't like to talk about it frequently, but it is a disadvantage. And we need to also focus on this, is that property values do at times go down. And the last time we saw them go down dramatically was in 2008, when it was the mortgage bubble, and there were a lot of foreclosures that occurred. And as a result of the foreclosures, people were rushing to get ahead of foreclosure activity. As a result, there was a high amount of supply of properties on the market, so property prices decline. Conversely, we're in a totally different environment right now. Because of telecommuting, you have a lot of people who would normally be going to the office each and every day, but you have companies such as Salesforce, Apple, Google, Facebook, that are not going to be requiring many of their employees to come back into the office ever again. So they can work from home for as long as they work for the company. So as a result of that, you have seen people look for that house that they want to live in, move out of New York City, move out of Chicago, move out of Philadelphia, and move to an area where they want to retire. So we have noticed that, particularly from the state of Maryland, south to Florida, there's been an enormous boom in property prices because of all the individuals that are coming from big cities to buy property with the idea they're going to telecommute. And if they need to go to the office, they'll just do an airplane once or twice a year. Of course, the other disadvantage that people don't tend to like to talk about is foreclosure. And that happens, and we actually are in a foreclosure environment, but due to the federal government and its various programs, it has been pushed off. So the can has been kicked down the road a little bit longer, but eventually properties will begin to hit the market. And when those properties begin to hit the market, you will notice property values going lower for certain. So that was just to give you a brief overview of what you need to think about if you're planning to consider purchasing property, be it a condominium, be it a townhome, be it a row house, a duplex, or be it a single family dwelling. Keep these items in mind. Renting versus owning. This is another thing you want to consider. Okay? Now, when you pay rent, remember that you're paying also an upkeep cost in your rent. But for the typical person that's paying $1,200 a month, they're paying $14,400 a year in annual rent. Over a 5-year period, that would be $72,000. And that's just $72,000 that's gone. Again, rent can be hassle-free, but also rent can go up. So that is a personal question that each and everyone must ask themselves. But on the other side of this coin is, of course, home ownership. And you could have been taking that $72,000 in this 5-year period and having it go into a home that you would actually own. So things to consider are, how much can you afford? What will be my total cost of ownership? What is my income? How much money do I need to save, or do I have saved? Or am I willing to save? What are my living expenses? Are my living expenses going to go up? Or will they go down? Or will they stay the same? And how many years do I expect to stay in the home? Again, very important questions that each individual should ask him or herself before considering home ownership. Remember that it starts with you. And I always have my clients who do home ownership counseling to do what I call a need versus want analysis, because they need to see if they're wasting money on a monthly basis. So I have them to do a need versus want daily diary for 30 days to figure out, write down every single thing, or they can put it in an app, every single thing that they buy, to figure out at the end of the month, how much money did they, and whether that money could go to better use by possibly going into a savings account, becoming a down payment. How urgent is it for you to move? Are you comfortable where you are? Do you have a good relationship and great rapport with your landlord? Or are they a pain in your butt? These are things to consider. How confident are you on your income? Are you in a job that is pretty much prone to economic activity? Needless to say, areas such as restaurants and food service have been hit hard during the COVID environment. Do you work at the hospital as a doctor? What are the preventions that you could take to avoid losing income? And how much have you saved? Are you planning on saving a lot? Do you like saving? Some people don't. Some people like to spend their check. So these are all questions that you must ask yourself. And regarding your credit, what kind of credit score do you have? How do the credit bureaus rate you? Are you good, bad, fair, or great credit? But whatever you decide to do, you need to have a plan. And you need to be financially disciplined. And remember, as I stated initially, your first home does not have to be your dream home. And as I stated, typically, the majority of the people that are homeowner tend to own more than one home, tend to own between 2 to 4 homes over their lifetime, because it can be an excellent way to build equity in a property and create wealth. Owning a home can also provide other financial benefits, such as I know of people who have had children who have gone to college and they needed additional money. So they were able to get a home equity loan, line of credit, in order to help finance their children's education. And the nice thing about a home equity line of credit is that the interest on that is tax deductible. So it provides you options that you normally may not have if you were just a renter. What is typically included in a mortgage? Principal, that's the initial amount that you borrow. The interest, that's the interest rate that you're going to be paying on the money that you borrow. Taxes, and insurance. So your monthly mortgage payment will basically include a percentage of principal, a percentage of interest, 1/12 of your tax bill for the year for your property taxes, and 1/12 of your homeowner insurance for home ownership insurance. And there is another item that may also exist. So, and rather than it being PT, it's PTOC, and that's an A. And the A would stand for association fee. There are a lot of planned communities where they'll have a clubhouse and a pool and a golf course and tennis courts. Well, that stuff is not for free. Or they'll have 24-hour security. There'll be a gated community, and they'll have a security guard in the little gated house, the gatehouse. And that security guard will be there throughout the night. Well, you got to pay the salary of that security. So that's part of the association fee. So if you're buying a single family dwelling, not in a development or one of those, excuse me, planned communities, then you would end up with principal, interest, taxes, and insurance. But if you buy in a planned community, you're going to end up with association. And the association fees may also cover things such as snow removal, ice removal from the street in the complex, or trash removal as well. So these are things to consider. Does a planned community make sense for you? You know, that's been a big trend over the last 10 years. They have these senior living community. You have to be, I think, 55 years old to get into them. And, you know, you have a house in it. But you can't have anyone under the age of like 18, I think it is, living there permanent. Or all permanent residents must be 55. So you can have guests, you can have your grandchildren, your nieces, your nephews over. But since it's a planned community, it's specifically geared towards senior citizens. Things to consider going forward. Make sure that you consider your employment. When you go for a mortgage, you're going to need to have 2 years of history. So you need to be in your job for at least 2 years. You don't have to be in the same job, but you have to basically be in the same type of job. So for instance, if you're working as a accountant at a accounting firm and you're getting paid a salary, that's great. And you move from one accounting firm to another, no problem. But let's say you move from being an accountant to now you want to be a car salesperson. Car salesperson is a commission employer. So they're going from a steady source of income to sporadic income. And that, you would have to be in that job for 2 complete years before you would be considered for a mortgage. The other thing you need to consider is whether you have other sources of income. Some people have Social Security benefits from the death of a spouse, or disability income for a family member, or maybe a rich uncle left them a pension and you're getting $10,000 every month or $1,000 every month. Those are other forms of income that you can use in declaring as your income against applying for a mortgage. They're going to also look at your debt. What debt do you have? Do you have a lot of revolving account, credit card? Do you have a lot of student loans? Are they in arrears? Are you up to date with them? Are they in forbearance? What's the status on it? What other debts do you have? Do you have an automobile debt? Are you paying an installment loan on an automobile? That typically can be the biggest obstacle to home ownership, is a big automobile note. Recently had a client came in, she couldn't qualify for much of a mortgage because she's paying $650 a month in a car note. That's an enormous amount of money to be putting it into a car when you're trying to buy a house. But they're going to consider all your debt versus your income. And then how about your down payment? Do you have a down payment? Have you looked into possible resources for getting a down payment? As I stated, there are several websites. You can Google this. Downpaymentresource.com. That's one of them. And it provides all the various state, county, federal grants that are available in your area for people who have taken the home ownership certification workshop. Okay? So these are things to keep in mind. Are you working on that plan? What are you doing to save? Do you have investment income? Are you putting it away? But you're going to need to have skin in the game in order for the bank to give you money for them to put their skin in the game. What does your credit score look like? Okay? Just so you know, to buy a house, you really need a minimum credit score of 640. Okay? And that's for a federally insured mortgage, backed by Freddie Mac, Fannie Mae, Veterans Association, Farmers Association. Okay? You can get private mortgages at a credit score of like 580. My recommendation to all my clients when they come into me is that they need to get to the sweet spot of home mortgages. And that's a score of 740 or above. When you get to that score, you reduce your costs. You have lenders competing over you to loan you the money. So your cost of interest is going to go down. All those little nickel and dime fees that they tend to add in will disappear because they want you in their portfolio. So you can buy a house with a 640. I recommend that you have a 750 or above. That way it should be smooth sailing. As I tell all my clients, my goal is to get you into the house and to have you in the house as long as you want to be in the house. I don't want you to get in a house and 6 months later, 18 months later, you're coming to me for foreclosure prevention. Makes no sense. So let's do the work up front so that we don't have to worry about it tomorrow. Other things to consider: closing costs. Your closing costs, depending on what part of the country you live in, is going to be somewhere between 3 to 5% of the home value. Okay? So you're going to have to escrow money. You're going to have to escrow a quarter of taxes. Some states, some counties require that you escrow 6 months. You're going to have to escrow a quarter of home ownership premium. Again, some states require half a year. Okay? You're going to pay processing fee. You're going to pay a loan application fee, credit report fees from all 3 of the credit bureaus. You're going to pay title insurance to make sure that the property that you're buying is free of and clear of all liens, so you won't have any problems going forward. You're going to pay for a survey. They're going to survey the property. You're going to know exactly how big your lot is and what's on your lot. It's going to give you a complete description. You're going to possibly pay attorney fee, or if you don't pay attorney fees, you're going to pay a closing costs fee to the title insurance company because they're going to be doing your closing. So these are all things that we need to keep in mind when we are considering home ownership. Not only are you going to have the down payment, you're going to also have closing costs. So that's just a very abbreviated summary of home ownership. Now, I'd like to ask, are there any questions that you'd like to ask me at this time that I can answer?
Thank you so much, Bernard, for those highlights and that important information. We do have some questions here. Our first question says, do mortgage lenders look at outstanding federal tax debt?
Yes, they do. Okay, because remember, outstanding tax debt, the 2 things we know you're going to do. You're going to die and you're going to pay tax. Okay. How many of you have been down in the loop and there's a building that is locked up and it's got a tax sign on it? The IRS, state tax people, do not play. They will come and get their money out of your hide. Okay? So they will garnish your wages. They will take you to court and put a lien against your property. So outstanding tax debt is something that most mortgage lenders are going to require that you take care of before they will approve your loan. And they'll tell you, you are pre-approved, pre-qualified with a condition that all your outstanding tax debt are fulfilled. Does that make sense?
Thank you, Bernard. Yes, I think we're good. We have another question from a participant asking which score do they look at, 2, 5, or 8? I think he's referring to Experian 2, Experian 5, or Experian 8.
Oh, okay. Well, there's a lot of different scores, and a lot of different mortgage lenders use different things. What I always recommend people to do, first of all and foremost, is that if you're really serious about home ownership, be certain to develop a banking relationship. Okay? So your local bank where you get your direct deposit, okay? Go in, get to know the branch manager. When you walk in the door on a Saturday morning to do your banking, if that's what you do, and if you don't do that, you should make it a practice to do it at least once a month so you can get to know the people that are handling your money. When you walk in, you want them to be able to say, "Good morning, Natalie. Good to see you." Okay? And the reason being is that when people know you, they will share information with you. Okay? Most likely that bank lends for home ownership. And currently, for instance, there's Bank of America in the Chicago area. Bank of America has committed $2 billion as a part of their Community Reinvestment Act to give towards mortgages throughout the US. Okay? So one thing we need to do is we need to talk to Bank of America and find out what they're doing. But typically, if you go to a mortgage broker, they're going to be dealing with a portfolio of banks, such as US Bank, Bank of America, Arcadia Bank, Esso Bank, banks all across the nation. And they're basically shopping your credentials to a litany of banks and see which ones are have interest in. Okay. That's a very transactional database approach. Nothing wrong with that. But I think you should always keep your options open. And therefore, I always say, make sure you develop a banking relationship so you can go and talk to the branch manager. The branch manager can vouch for you. The branch manager can refer you to the best loan officer in the organization, okay? And then they'll tell you what scores they look at. Because there's a bunch, there's the Advantage 8, I think, there's a 9, there's a bunch of different scores that you can look at. Experience got different scores, Equifax and TransUnion. They all have different, and they all call them slightly different things. So keep that in mind. Develop that relationship with your local bank so you can ask the questions of what they look at and find out exactly, okay? That's a good practice to put into force.
Thank you so much, Bernard. As a former financial branch manager, I can vouch for that. If you know your manager or you know your banker, they'll be more inclined to help you. So we have rapid fire questions coming in.
Okay.
So let's try to tackle these together. The next question on the list was, what's a good down payment for buying a home?
Okay, a great down payment for buying a home is 20% down. Okay, 20% down, you don't pay what is known as PMI, principal mortgage insurance. That's an additional cost when you don't own 20% of the equity in the house. Okay, so whether you get a conventional loan with 3.5% down, because that's typically what you hear a lot of now. With a 3.5% down loan, you're going to pay PMI. So in essence, what you're doing is you're paying a fee to the bank to guarantee them that they'll be made whole if you are foreclosed on. They'll get all their money back. So you're paying them to get, so they have that advantage. To me, that's giving away money. So the greatest situation to be in is to have 20% down. Okay? Now, good situation, put down as much as you can put down. Know that you're going to pay that PMI until you get to that 20% equity threshold in the property. Okay? And I'm not saying don't go and put 3.5 or 4% down. I'm not saying that. I'm saying just realize that that's what you're doing. You're incurring an additional cost when you do that. Thank you, Natalie.
Excellent. Thank you for sharing. So we have a lot of questions coming in, so we want to make sure to be able to get to everyone. Next question on the list is, if I purchased a rental property, can I stop from being considered a first-time homeowner if it wasn't to purchase a house? So I think what she's trying to say is, can she still be considered as a first-time home buyer if she has a rental property?
Yes, provided it's considered a investment property.
Perfect. Next question on the list is, how much approximately would you spend after fees and everything? I think she's referring to like the good faith estimate when you factor in either closing costs or insurance. What's like a guesstimate figure? Like say, for example, you had a house that was worth 200,000. Like what's a guesstimate of what a good faith would turn out to be?
As I stated earlier, closing costs all in are going to be somewhere between 3 to 5% of the value of the home. That's transfer fees included, fees that you have to pay, shut off, water, turn water back on, gas hookup, etc. It's going to be on the higher side of 5% for places like Chicago, New York City, Atlanta, Georgia, North Carolina, 3%. Does that answer the question?
Yes, of course. So I'll even take that a step further. So if you take 3% on $100,000 or 5% on $100,000, that's an equivalent of $5,000, between $3,000 to $5,000 in closing costs and fees. Am I correct?
Everything. All in, yes.
So per $100,000, just think between 3,000 to 5,000, and that should gauge you or get you kind of close. And if you want to have advice, or if you wanted to speak to Bernard offline or a private, I'm going to post his information in the chat. Next question. So if you have inherited property, are you still considered, oh wait, we got to that one. Next one. So can someone reporting an ITIN, so it's a number considered for, it's used often by immigrants or migrants.
Okay.
An ITIN number is used, it is valid. You can open a bank account with it, although
Yes.
not being either not having full citizenship, or you can open bank accounts with it. I'm not sure if you can get a mortgage loan with it, though. Can you?
I would have to research that. I don't want to say the wrong thing. So my answer at this point is I don't know. Have that particular client contact me and I will find out. Okay. It may be a state by state situation. So for instance, I'm thinking that in California, it is allowed. Okay.
Okay. Yeah.
I'm thinking in certain states, it won't be allowed. I do see a question in the chat. I'm going to answer if they can hear me. It's a young lady talking about bankruptcy. Okay. Regarding bankruptcy, just so you know, you can apply for a mortgage, only an FHA mortgage, 2 years after bankruptcy. That's the only place you're going to be able to get a mortgage. Okay. Typically speaking, if depending on what type of bankruptcy you file, it could be 7 to 10 years. So for 7 to 10 years, anything else is not going to be possible. All right. There was a question about inactivity when you get a credit card closed or a department store card closed. That reduces your credit score because it reduces your capacity utilization. Well, my question to the person who said they inherited a house is the house in your name? And how long has it been in your name? If the house has been in your name for over 3 years, you'll then be considered a first-time home buyer. If it's been in your name for less than 3, you won't be considered. All right, someone asked something about how does one get the inherited house into their name? Well, was the property given to you in a will? You have to have proof that the property belongs to you, then you can get it put in your name. So if there's proof that you own it, i.e. a will, the will should have gone to probate court and the court should have put the property in your name. Unless it was given to multiple people, then it would have been put in the names of those parties. Okay, I'm reading this question from Esther. I need to find out more about that in order to answer that question. I need to talk to you more about that issue in order to be able to answer your question, okay? Because it sounds like it's fairly complicated. And my one last thing I do want to say is that email me. Don't call my office number because we're still under COVID protocol, and I go to my office maybe once a week at the very most right now. So please email me. My email address is bernard.whitsitt@operationhope.org. And be sure to tell me that you were in this particular workshop so that I will have a point of reference when talking to you. Are there any other questions that I could answer in the chat at this moment, or are we good to go? Okay, I got a question from Millie. Millie, you need to call me or email me. We need to have a more in-depth discussion before I can help you on that one. Remember, I had mentioned downpaymentresources.com. Google it, okay? You put in your zip code and it'll pull up what's available. You need to check that on a weekly basis because it is very dynamic, changes frequently. So something that may be not available today could be available next week. So you have to make it a concerted effort and part of your schedule to check downpaymentresources.com weekly. Thank you, Natalie, for putting my contact information in the chat. I truly appreciate that. Okay. Again, don't call me right now at that number because it'll probably take me a week and a half to get back to you. Come to my office and I got probably 18 messages on the phone right now. So if you want a quicker answer, email me and we'll go from there. I'm so sorry for the technical difficulties we experienced. I hope that you found the information that I provided to be valuable. And if there's any questions or any way that I can assist you going forward, whether you like to consider home ownership counseling, we can have that discussion, okay? Yes, that would be. So if you're looking for downpaymentresources.com, you would put in the zip code of where you want to live, okay? Because that's where that grant is going to be attached to, that zip code. Very good question.